The question I have today is about MASIM. Why isn't it a takeover target for one of the conventional telcos?
I think it will be eventually. MASIM has a pretty watertight contract with Optus until about 2021, I think it is, or 2022. And until then, it's very difficult for someone who takes control of it to get off the Optus network. I think the most logical buyer of MASIM is actually Optus itself. Because once those customers are inside the Optus network, each customer is actually worth more to Optus than it is to any of its rivals. So I think eventually you will see some sort of tension there. TPG is now building its own mobile network and has said they need about 3 million customers to break even. There are 1 million customers sitting inside a MASIM at probably a cheaper cost than they could access them through traditional marketing means. So I think you're quite right that there will be some competitive tension, and that customer base is starting to become a strategic asset.
A very simple question, which I should really know the answer of myself. Apart from in your funds, the 0.77% you charge, is there anything on top of that?
So it's 0.77% is the management fee, and that's all inclusive. There are transaction costs because we buy those individual shares in your portfolio on your behalf, but we actually pool that. So we can do that for 0.5% and 0.05, I think. 0.05% and 30 cents. So the transaction costs, I've got a fair bit of money in these portfolios. I think most times, the transaction costs are a few bucks. I mean, it's not, but I can't tell you the exact amount. But also in those ETFs, similar to Gorap's portfolios, we don't change them that much. We probably, I think Gorap's portfolios have about a 20% turnover a year, and ours are probably similar to that. So, again, we're very much in the camp of II where it's all about holding, and we only change when necessary because of those rebalancing and transaction costs.
And in what you invest in, or in any of your funds, is all that information available in InvestSMART, the research that you do?
It's all on the website.
I've read stuff around people not wanting to sell shares, or big investors not wanting to sell shares because they don't want to realise the gains. And you've also talked about rebalancing. If there's a stock that you really like it, but it's gotten to a point where it's actually quite excessive, it's done really well. What do you think about that idea of not actually selling it because you don't want to realise the gains? Does that make sense?
Yeah. So I think Gorap's going to have some answers for this as well. But we've a number of people have asked those questions to the panel over previous seminars.
Yeah.
Especially with sort of bank shares. People have had the shares for a very long time, and bought them. GFC, you could have bought a lot of these banks for $20, and now they're sort of $70 or whatever else, and there's large capital gains. Again, we don't give personal specific advice. But my sort of answer to that, and Gorap might have a different one, is if you knew the GFC was going to happen tomorrow and was going to halve your stock, would you be that worried about paying some tax on it?
Right. Yeah.
Look, the only thing I'd add really is that in our own portfolios, once a position gets to about 10%, we would probably automatically trim that regardless of what the value of that stock was. You don't want to be in a position where one idea or one company will determine the performance of your portfolio. It's just a very risky place to be, no matter how strong the stock or how strong the idea. So, as I was saying before, there's lots of different paths we can go down, and we're only ever going to go down one of them. We don't want that determinism to determine our portfolio return. So a general rule we recommend is about 10% as a maximum holding for any idea. If it gets more than that, we would automatically trim.
So it would be depending on the stock and your thoughts around the stock. It would be either rebalancing or going, do you know what, I'm out? Because you got out of South 32, is that right? But that may be a stock that in the future you're interested in again, I would suspect.
Yeah, we actually put a sell on South 32 quite recently, and so we exited that position entirely in our own portfolios, and we recommended members take profits as well. I would get interested in that again at a much cheaper price. We bought that when it was making no money, when no one wanted to touch it. Very different scenario now where it's making a bonanza and everyone's all over it. So it'd have to get very cheap again for us to get interested again.
I notice you recommend around about 30% of shares should be in international equities. I have in my super fund Macquarie, Westfield, CSL, etc. I count those as international equities, and I think I'm getting close to that figure with those, seeing most of their income is international. Do you agree with that, or should I be looking further?
From my part, I think I agree with that, and I think Gaurav will as well, but Gaurav can answer for himself. But just going back to the portfolio manager for a minute and that health check, what that health check allows you to do is, let's say we get it wrong, let's say we go CSL, because it's all digitized, yeah? So if we go CSL, and a lot of people ask us about Westfields or Sydney Airport, you know, they might go Sydney Airport's property rather than, or Westfield's property rather than Australian equities. You can actually change the mapping. So we allow everybody to change the mapping. So if we say CSL is Australian equities, which we do, that's our global rule, but your local rule, you might say that it's actually international. And in fact, if more local people tell us that it's international or something else, then the global rule actually switches over. And so new people coming in. So the system sort of learns itself. So you can change the mappings, you know. So because it's about what you believe, yeah. Something else we're bringing into that portfolio manager as well, just to let you all know, is we're also bringing in your own custom asset allocation. So some people, for whatever reason, may believe that, you know, I don't want 30% in international equities, but I really like the technology in telling me where I'm over and underexposed, but I want to set my own asset allocation. And it just really allows for more sophistication. We deal with, 700,000 people. We deal with people from the start of their investing journey towards the end of their investing journey, and we have sophistication levels all the way in between. So we try to make the system smart enough. And the great thing is now with 12 dev people, 12 little geeks sitting in the office. They're not little, but and we've spent sort of 2 years integrating all these businesses. Now they're sort of like really starting to stretch their arms and do some really cool stuff.
Question for Alex Hughes. With retails on the ropes at the moment, there is two companies that stand out. One is the Reject Job, and the other one is Metcash. Metcash went through their low about 18 months ago, and that was $1. They're now trading at $2.75, pushing up. They've already reached 85 a few days ago. The Reject Job went through a low only about 6 months ago of $3.35, 25, somewhere around there. They're now trading $5.20. Are they part of your portfolio?
No, they're not. We haven't invested in either of those two businesses, but we have looked across the retail sector, and we've been trying to identify businesses which can withstand the threat of Amazon, which have strong financial balance sheets, so they can ride out any economic turbulence, and just have good concepts which we think can stand the test of time. And as yet, we haven't found anything. We've considered a number quite closely, but we're quite cautious because retailers have lease liabilities, and it's economically similar to debt, and that's a very big portion of their cost base. And if a retailer's sales start to fall, same-store sales start to fall, they can really get into trouble quickly. And one example is Oriton, which is very close to bankruptcy in our opinion. There's probably a capital raising at the moment, so we're very cautious on the space, but we're still interested. So I guess watch this space.
We actually had a really close look at the Reject Shop, but we came to a conclusion that they have about 400 stores, right? The model is to buy a whole lot of cheap stuff from China, discontinued lines, runoffs, that sort of thing, and fill their stores at really low prices but good margin. It's a good concept, but they've now scaled that concept to 400 stores. I think that's too much. This is a concept that works for 60 stores maybe, and they've managed to squeeze 400 out through it. And I think this company needs to dramatically shrink, or it will go out of business. So we looked at it really closely, but we decided that management needs to shrink the company, and until it does, we're not going to be investing dollars into it.
I'll just add to that there's an analyst in our group that thinks the reject shop will go bankrupt. So we're pretty cautious on it, to be honest.
Just a comment on Reject Shop. I looked at it a few years ago. Just the metrics, about half of its turnover is from things like Christmas, etc., and the other half is from sort of consumer normal stuff like you find in supermarket. The stock turn on the supermarket stuff was going sort of south, but manageable. That could do with news. That can be changed. But the Christmas, the seasonal stuff was just dead, and the stock turn was around 4. It was a supermarket you expect closer to 10, 12 or higher. They just had the amount of stock is just ridiculous. And I haven't looked at it for a couple of years, but I would expect that continues. And it's a really simple thing to check. You just walk around just seeing. So any retailer, if you walk in and it looks good, that's already a good sign. But I'd suggest that Reject Shop is not a good look.
Yeah, just to add to that, you're exactly right. It's a very seasonal business. They make most of their money in the first half. The second half, they barely break even. Sometimes they lose money. So if they make a mistake in the Christmas period, their financial results get trashed. So, yeah.
Well, I hope my questions aren't too naive, but I want to know what happens when interest rates go up. What happens to my equities? And also with all these ETFs, there seem to be so many and they're holding similar stocks, a lot of them. What does that do if people have to sell quickly and there's kind of everyone is trying to sell the same underlying stocks at the same time?
They're not naive at all. Very important questions. The best investment minds in the world are actually grappling with both those questions at the moment, and I don't have any definitive answers for you. There is no doubt that low interest rates have created heightened asset prices across the world. And we're not just talking about stocks, stamps, comic books, collectible cars, wines. Any asset you can hold has been inflated because of low interest rates. So once interest rates start to rise, a lot of that asset price inflation will also start to unwind. I think that's when stock picking becomes even more important. It's important to hold undervalued securities. The stuff that has risen a lot because people are simply bidding up the prices is going to fall right back down again as people de-risk and those PEs get compressed again. But our aim is to buy stuff that's worth less, that's priced less than it's worth, and I think that puts us in pretty good place for higher interest rates. Your second question about ETFs is really important as well. I think this is one of the great opportunities for active managers like ourselves. Every time you have a pool of capital unthinkingly buying stocks is an opportunity. Everyone who's in an ETF or is in an ETF fund buys stocks because of the size of that stock or its inclusion in an index, not because it has anything to say about the fundamentals of that business. And that creates opportunities for us. That means things that are technically outside the index or that have been missed get undervalued. The pool of capital bypasses those securities altogether, and we can pick them up cheaply. It means that businesses that are inside indexes can be very expensive, and we know to avoid them as well. So it's both those things are very important. We do think about them. Everyone in the world is thinking about them, but I'm afraid there are no easy solutions. Holding underpriced securities is the answer to almost every investment question.
I'd also like to defend ETFs. We have this constant battle internally as well. So we've just released an ETF report. It's about 30 pages and looking at every ETF. So we don't think every ETF's the same as every other ETF. Similar to shares, they're different. We do think that low interest rates have pushed up all asset prices like Gaurav. There's no doubt about that. But ETFs aren't too dissimilar to a managed fund in that, just because it's in an ETF, you also have shares inside of managed funds. And when you have, let's say, a run on a fund or a run on an ETF and they have to sell those underlying shares, that's exactly the same that happens with a fund. We do agree with Gaurav that, you get the good and the bad with an ETF. An ETF buys everything in that index. But also most likely is the bad ones get similar to an II portfolio, and they always tell me this is a joke, that your worst decisions become smaller problems because the weighting of that becomes smaller and smaller in your portfolio. That exact same thing happens in an ETF and a managed fund. So if you've got illiquid stocks for whatever reason, because the active managers aren't buying them or the ETFs aren't buying them, or it falls out of an index, then it just becomes less and less of a problem. You're dealing with funds that are buying, the ones that we choose are sort of like iShares 500 or something. You're buying the top 500 stocks in the US market. They are very liquid, and most fund managers would also have them in their funds.
I'll just add one more little thing to that, and in Ron's own presentation he talked about plugging your gaps, and really a good portfolio can utilise both active management, as in stock picking, which is what our guys there do, and also products such as an ETF, which make it extremely easy to buy a whole market, a whole segment, a particular theme, and you can really sort of cover things quite cost effectively that way, and that's a strategy that I use.
Hello, Sean here. Could somebody explain the practical difference between listed investment companies, LICs, and EFTs, and why have EFTs seemed to have gained more coverage recently?
Thanks for that.
LICs are just a managed fund, but with the access being on the ASX. So a traditional managed fund means you put money with a fund manager, and they buy units in their fund, which invests in companies that they determine. So they pick and choose the companies, you provide the capital. In a traditional managed fund, you've had to apply via paperwork to put your money in and apply via paperwork to get your money out. An LIC simply means that that fund is listed, so you can access the vehicle via CommSec, and it just makes it cheaper and easier to do that. An ETF is a different thing altogether. An ETF tracks an index or a basket of securities, and it's not actively managed. So the things that the ETF will track will be like the ASX index, the S&P, or the commodities index, the currency index. They track a particular index and they stick to that tracking. So they're not making a decision about whether that index goes up or down or changing their weightings to it. They're just trying to track it. An active manager will make decisions about what will go up and down and change the allocation accordingly. I should add, I think ETFs are a terrific idea. For most people, they should have a lot of money in ETFs. I just think you should be realistic about the returns you get from them. A good active manager will be able to exploit the inefficiencies created by ETFs, but not every active manager will. So just to clear up, I think they're a terrific product and a great idea. My own dad uses them. I recommend ETFs for him. But it's quite a different strategy and different outcome to an active managed approach.
Yeah, I think Gaurav's completely right. So ETFs track an index, usually very, very cheap, which is why everybody's going into them. So, that iShares 500 is like 8 basis points or something like that. Whereas a LIC, even Argo and those guys are like 20 basis points, and most LICs are actually probably more similar to a managed fund where it's, up to 1%. So, a lot of people are diving into the ETFs because of their cost effectiveness. I think there's also media and journalists play a big part in the love affair with ETFs at the moment. But that it's probably more about fees. I completely agree with Gaurav that active managers should be able to beat an ETF. But it depends on your core competency. The reason why, Gaurav puts his dad into something or I'm in ETFs because I've got I trust the II guys. We don't have any ETFs or any portfolios of ETFs for Australian equities as that asset class because we've got core competency in that. But if you don't know, a good manager from a bad manager in the international, or you don't have competency yourself to pick individual stocks overseas, then ETFs and those sorts of vehicles provide a very easy and accessible way into those other asset classes.
Interested in the returns from this small cap companies fund, like some of the examples you had quite looked like it had a lot of upside, but I'm not sure the returns have flowed through into the fund.
Yep, so we launched in February and we have invested in the companies that I talked to earlier at various times since then. So Global Construction Services was one I think we've made on our initial purchase price, because you have to remember that we have purchased it over a period of time. I think we've made about 50% from the first purchase price.
I've got those numbers up behind you.
So this is the fund overall. So since inception is on the far right at the top. So we've done 25% since February. The index is up 14.7. We try not to focus too much on the short term because it's a long-term game. Things go up and down. We're going to make mistakes. We're going to have good and bad fortune. So we're really thinking about 5 years, about building a good portfolio for that. But we're encouraged by a good start. But yeah, in terms of the individual holdings, so Global Construction about 50% on initial cost. Redflex, we have entered more recently and we've participated in the capital raising, so we haven't really made money as yet from it. And Academies, it went up at about 11% yesterday, so we've made about 35% from that thus far.
Yeah, we hope they go really well because most of the staff, including myself and our chairman, are in it. And Paul Clitheroe only just recently went into it, so there's no pressure.
And just a quick point on the focus of the fund. We're not trying to make this a very big fund. We want to keep it a small fund, nimble, so we can pursue these opportunities to make good returns. And as Ron mentioned, we're investing in ourselves. So we also want good returns alongside you.
Yeah, we will actually close the fund once it reaches a certain size. We're more interested in making high returns than making fees, to be honest.
The fund is just over $10 million now, and our fee structure has two components. There's a management fee and a performance fee. The other products that we mentioned earlier don't have performance fees, so this is a new thing for the Small Companies Fund. The management fee is 97 basis points, and the performance fee is 10.25% of the gain that we make over and above our benchmark. So our benchmark is on the screen. It's the Small Companies Accumulation Index. There's also two other components to that. So we have to make a positive return. So we're not entitled to a performance fee, I should say, if we lose less than the index does. And we also have a high watermark as well. Yep. Historically, small companies are more volatile and will get sold off more heavily in a situation like that. So how are we trying to go about positioning the portfolio to protect from that? Some of the companies we're holding, we're thinking about their earnings exposure. So investing in things with international earnings, earnings not derived from economically exposed things, discretionary spending and so on. So we're going about it that way, and we also have higher cash balances as well. It's fair to say that we're not trying to predict when markets are going to crash because we don't think anyone can do that, and when you do that, you're trying to time the market, and that's not our approach. But smaller companies are likely to do less well than larger equities in a big recession. But in saying that, there is opportunity out of that because they get sold off more heavily. So the return profile coming out of that is stronger, and it's important to think about the long term of this as well, because smaller companies tend to make higher returns over longer periods of time. They're more volatile, and so you have to be in a position to withstand that, and thinking long term, and having smaller companies as a percentage of your total asset allocation in a comfortable amount.
This might be a basic question, probably is. I keep thinking about timing getting into the funds, especially the ETFs. Is there such a thing as time? Like I imagine the value funds, you're always rebalancing and things like that. Is there such a thing as do you think there's such a thing as timing when you come into the funds?
You know, if I'm well overexposed, when's the best time to do it? I mean, well, it's whether you can sleep at night. If it's keeping you up at night, then you probably are well overexposed in that. So if you're well overweight, like the ASX calls it in those that axe, those two blades in property and Australian equities, and you're worried all the time about property, then that probably suggests you're well overweight property and maybe you want to do something about it. The best time to buy, I think the best time to buy is when you find that there's something undervalued. I'll let Gaurav answer those questions. There are techniques. There is also in between. So there's dollar cost averaging and that sort of stuff where you constantly sort of buy a little bit. I mean, superannuation is a great thing for that because you only have that money every month or whatever is coming through your wage. So that allows you to top up.
I don't think timing really matters because your return will come not from the companies that we own today, but the companies will get you in tomorrow and in the future. I've got to say, I think for the ETFs, timing is important. I'd be, careful about an American ETF or one of those FANG ETFs at the moment. I think it is important, but the solution is probably to dollar cost average, to buy in tranches and to spread your entry out over time, and that probably will save you from being exposed to any one particular moment.